AP, New York, with a half-point increase on Wednesday, the Federal Reserve's benchmark interest rate reached a range of 4.25% to 4.5%, the highest level in 14 years. The seventh rate increase this year by the Fed will make borrowing for homes, cars, and other purchases considerably more expensive for families and businesses. On the other side, you'll get a little bit more interest if you have money to save. The Fed raised rates by a smaller amount on Wednesday than it had in its previous 4 consecutive three-quarter-point increases as part of its efforts to combat excessive inflation. The downturn is partially due to the economy's cooling and the reduction of inflation. Observe the following. The quick response is inflation. Consumer inflation in the U.S. has been recorded at 7.1% over the past year, an uncomfortably high rate despite the sixth consecutive monthly decline. The Fed wants to reduce consumer spending, which will eventually cool the economy and drive down prices by diminishing demand for homes, vehicles, and other products and services. Jerome Powell, the chair of the Fed, has admitted that escalating interest rate increases would hurt people, but that they are required to combat high inflation. According to Scott Hoyt, a Moody's Analytics analyst, anyone taking out a loan to buy a big-ticket item like a house, car, or large appliance will suffer. Hoyt pointed out that despite recent increases, household debt payments as a percentage of income remain modest. As a result, many households may not immediately feel the effects of rising borrowing costs. The majority of consumers may not be thinking about interest rates right now, according to Hoyt. They appear to be more concerned with their shopping and the situation at the petrol station. The concept of rates might be challenging for consumers to comprehend. According to Bankrate.com, credit card borrowing rates had already risen to their highest point since 1996, before the Fed's most recent action, and they are certain to keep rising. A survey research company's polling, according to John Lear, chief economist, reveals that more Americans are using credit rather than depleting the funds they built up during the pandemic. Eventually, rising rates could make it difficult for such households to pay off their debts. People with poor credit scores who aren't eligible for low-rate credit cards already pay much higher interest rates on their balances and will continue to do so. 0% loans advertised as "buy now, pay later" have also grown in popularity among customers when interest rates have gone up. However, these businesses' longer-term loans with more than 4 installments are subject to the same increasing borrowing rates as credit cards. The rising yields on certificates of deposit, CDs, and high-yield savings accounts have brought them to levels unseen since 2009, thus families may desire to increase savings if at all possible. Bonds and other fixed-income assets now offer higher returns. Online banks and other institutions that provide high-yield savings accounts can be exceptions to the rule that savings, CDs, and money market accounts do not normally track changes in the Federal Reserve. These institutions frequently engage in fierce competition for deposits. The catch: they occasionally demand incredibly high deposits. In general, banks seek to take advantage of a climate with higher rates to increase their profits by charging borrowers higher rates without necessarily providing savers with greater rates. The benchmark rate set by the Fed doesn't always move in lockstep with mortgage rates. Instead, they frequently follow the yield on 10-year Treasury notes. Sales of existing homes have decreased for 9 straight months as borrowing rates have become too large a hurdle for many Americans who are already paying considerably more for food, petrol, and other necessities. You probably have more possibilities now than at any point in the previous year if you're financially able to buy a home. Most significant, though, is the monthly payment, on which most consumers base their auto purchases. According to Edmunds, prices for new vehicles have increased since March by an average of $61 to $718. The typical monthly payment for a second-hand car has increased by $22 to $565. According to Ivan Drury, head of insights at Edmunds, financing a new car with an average MSRP of $47,000 currently costs $8,436 in interest. That alone will drive many people away from the car industry. According to Drury, "I think we're actually beginning to see that these interest rates are doing what the Fed wants. They are reducing purchasing power so that you are unable to purchase a vehicle. The number of those who can afford it will decline." Since the Fed started hiking interest rates, the value of cryptocurrencies like Bitcoin has decreased. Many once highly valued technology stocks have as well. Because their yields have increased, safe assets like treasuries are now more appealing to investors due to higher rates. That makes riskier assets like technology stocks and cryptocurrency less enticing. However, issues unrelated to economic policy still plague Bitcoin. Investors' faith in cryptocurrencies has been shaken by the failure of three significant organizations, most recently the well-known FTX exchange. Some economists contend that in order to stop price increases, layoffs may be required. One claim is that a labor market that is too tight leads to wage increases and greater inflation. But in November, firms across the country continued to hire quickly. Borrowers who obtain new private student loans should be ready to make higher payments as interest rates rise. Currently, interest rates on government loans range from roughly 5% to 7.5%. That being said, as part of an emergency measure put in place early in the pandemic, payments on federal student loans are frozen with no interest until summer 2023. Additionally, President Joe Biden promised loan forgiveness of up to $20,000 for Pell Grant recipients and $10,000 for most borrowers, a measure that is currently being contested in court.